Good afternoon, everyone, and welcome to this video interview where we'll be talking about market and regulatory evolutions shaping the ETF market in the next few years. I'm delighted today to be joined by Scott Clemens, Partner and Chief Investment Strategist at Brown Brothers Harriman, Andrea Murray, Vice President of Investor Services at Brown Brothers Harriman, Monica Gonya, Head of Financial Institution Law Group at EY, and Deirdre McIlvenna, Partner of the Funds and Investment Management Group at Maples. Great to have you all here today. Scott, coming to you first, what are some of the key developments to watch in markets in the coming months? Obviously, been a very active year, sort of looking at sort of interest rates, inflation, jobs data, and geopolitics. It'd be great to get your view on things.
Yeah, there's an old saying that says the optimist believes that we live in the best of all possible worlds, and the pessimist fears that he is right. At least here in the States, everything seems to be firing on all cylinders. Preliminary GDP for the third quarter came in at 2.8%, pretty broad-based strength, enough improvement on inflation to allow the Federal Reserve to begin lowering interest rates. We think they'll continue to do so throughout 2025. It's a really good backdrop both for markets and for the economy as well. The thing that I'm watching very carefully as we head into 2025 is how sustainable the strength of household spending is. That's 68% of the American economy. Four things in particular that I'm focused on: continued strength in the labor market, the amount of household debt, which in the United States is a staggering $18 trillion, the amount of household savings, which is on the other end, a scarily low number, and a worrisome early rise in credit card delinquencies. I consider these to be storm clouds gathering on the horizon. You don't need to find your umbrella quite yet, but you should probably know where it is as we head into the latter half of 2025.
Yeah, great stuff. And coming back to you on that, Scott, what are some of the key risks and opportunities that this backdrop creates for ETF investors?
Well, the key risk for investors is the uncertainty related to the path and the pace of how the Federal Reserve lowers interest rates. And we've seen some volatility in the markets already surrounding that. When the Federal Reserve lowered interest rates 50 basis points in early September, the market quickly built in an expectation that the Fed was behind the curve and would need to cut interest rates 0.5% at any number of meetings. Well, of course, since then, we've had a number of stronger economic readings. So we're at that point in the cycle in which there's a shift and a push and pull in market narratives that'll likely lead to volatility, interestingly, both in traditional fixed income as well as equity markets. Now, for some investors, this is more of an opportunity than it is a risk, but it's a little disconcerting nonetheless. And this is, by the way, normal for this kind of a turning point in monetary policy. It is not unique to this cycle. Indeed, it's not even unique to the American markets. Anytime you've got a change in monetary policy, it heightens the uncertainty surrounding the future path of financial markets.
Great stuff. Monica, coming to you with a similar sort of question. Obviously, Scott's painted us quite a detailed picture there, but it'd be great to hear your thoughts on some of those risks and opportunities out there that ETF investors should be mindful of.
Yeah, I think from an investor's perspective, obviously, I defer to Scott in terms of his detailed analysis. I think for investors, they are always tracking these trends. Where can they seek that alpha? Where can they take advantage of where there are market inefficiencies that can be spotted? One of the things that we certainly still see as repeated questions that always come out in relation to investment from ETF investors is, well, where are the thematics? What kinds of funds are being launched? What does that address in terms of our needs in particular? So is that ETF being used as a tracking error? Not so often anymore. Is it really to help with liquidity? Yeah, sometimes there's definitely a consistent use of it from that perspective. But at the same time, for retail investors in particular, it can often be just, well, this is new to me still. What is an ETF? How does it work? What is the difference between this and a mutual fund? What's an active ETF? Why was an active ETF better than a traditional index tracking ETF? So those are the types of things that we're certainly seeing our clients, our managers ask us as to, these are the things our investors are asking for. How do we address it? Whether it's in the structuring, whether it's in the distribution model, when you're choosing which jurisdiction are you going to launch. I mean, both Deirdre and I weigh green, so maybe that gives you an indication, but I am neutral and it can be any EU jurisdiction, even the UK maybe. But equally, when you're looking at from a cross-listing perspective, what is it that you want to achieve, and how are you going to make sure that you've got a distribution channel that meets those investors? I think that's the key, particularly when you look at European trends in particular. We've all been very, very excited about the growth. This is a $1 trillion industry. Fantastic, fantastic, fantastic. However, how is that dial going to turn? It's probably going to be when that retail market really does expand, and that is distribution. And that has been something that's been going on for years now.
Great stuff. And Andrew, I'll come to you as the last one I address this question to, but looking at those risks and opportunities, what should investors be sort of mindful of at the moment, sort of in the ETF market?
So what we're seeing in terms of, the geopolitical risk and the comments that Scott had made in terms of ETF investors, you'll see a number of things. One is looking at buffer strategies as an example, which is very popular in the US. It's starting to grow in popularity here in Europe as well. You also have the thematics like Monica mentioned. And then thirdly, we're actually, even though there have been record inflows into ETFs this year globally, particularly in Europe as well, there's a lot of investors that are sitting on the sidelines, probably most likely retail investors, like Monica mentioned. So I think once we get past that election phase, we'll start to see more inflows into particular products once the calm is kind of settled based on what the election results are.
Yeah, fantastic stuff. And moving away from the sort of macro side, obviously we've got some lawyers here in the room. It'd be rude of us not to move into sort of the regulatory focus. And obviously there's a lot going on at the moment. So it'd be good to dive in maybe to look at some of those regulatory changes on the radar, and sort of which ones are going to be key over the next year. Deirdre, I'd like to bring you in here. Obviously we've had the sort of overseas fund regime, some big developments there recently. I probably don't need to bring up the recent developments with listed share classes, but I'll let you take it away. I'm sure there is quite a lot to be said there.
Great, thanks, Jamie. And I'm conscious that there's always a lot in, I suppose, kind of the regulatory side of things. And so for fear of losing the audience, I might just focus in on kind of 3 specific points. I was going to talk about the overseas funds regime because I think that's really important from a product distribution perspective. I'm also going to, I suppose, kind of talk about the ESMA ESG naming guidelines. Again, important from a distribution perspective, just in the context of greenwashing, but also actually in terms of product development. And then finally, we might just have a quick look at the UCITS Eligible Assets Directive call for evidence from an ESMA perspective, because I think, again, there's quite a bit in that as well. So just maybe to kick off with the overseas funds regime, it was great to see the UK government grant equivalence for UCITS ETFs under the overseas funds regime earlier this year. It definitely brought the much needed clarity for asset managers that want to continue on to sell UCITS ETFs in the UK, but also for new managers that are looking to distribute in the UK. It's long been spoken about, this was kind of the uncertainty for new managers which have been created by Brexit. So the overseas funds regime is seen as a key way of removing post-Brexit barriers for new EU domiciled ETFs when entering the UK. Now, for existing managers, and I think this is probably the one thing that we are kicking off discussions with our clients on, is looking at what piece of work needs to be done. And there's going to be quite an extensive exercise of providing and validating all necessary information and ensuring that there are no conflicts with the areas of concern that have been identified by the FCA. And I wouldn't underestimate that task. In addition, there will also be ongoing obligations that will need to be considered. So, there's a lot in the overseas funds regime. It's a really welcome clarification, but it's also going to be a big project for existing managers. But it creates a gateway now for new managers that are coming into Europe. And looking to access the UK markets. In terms of the ESG naming guidelines, in May of this year, ESMA published its final report on fund names which use ESG or sustainability related term. The guidelines include thresholds for asset allocations, as well as exclusionary criteria that vary dependent on whether or not it's a ESG or sustainability related term in the name. And all of this is with the aim of tackling greenwashing and misleading product marketing. In terms of the impact, we expect that several asset managers will drop the ESG term from their fund names. Some are going to go with transition, while others are likely to divest from certain investment holdings or reposition their holdings in terms of being able to retain the ESG or sustainability related terms. So a lot again in that, and from a product development, a product marketing perspective. But importantly, in the context of, I suppose, kind of the broad spectrum of passive ETFs, we are seeing the likes of MSCI announce the removal of ESG from their benchmark names, which is going to be effective March of next year. And this will result in a change of name of the fund, as the index name is often used in the name of the fund. Other issuers are going to now have to look at the index composition to ensure that they can uphold the requirements under the guidelines. So I suppose kind of helpfully, the central bank has introduced a streamlined process to effect the change of name, but just to note that any other changes resulting from the guidelines will need to be considered as a post-authorisation amendment. And we very much understand that the CSSF and other regulators across Europe are adopting a similar approach. Finally, just to touch on the call for evidence on the UCITS Eligible Assets Directive, because I think it's a really interesting discussion point. I think, you're looking at what's happening in Luxembourg in the context of CLO ETFs. There's a huge amount of interest in that area. And I suppose kind of it opens the question as to whether or not we're going to see a new wave of asset classes that will be eligible or suitable for investment by UCITS, or potentially, and actually, I suppose kind of the direction where we wouldn't like to travel is where maybe a more conservative approach has been recommended. One thing, though, that is quite clear is the need for better regulatory convergence in terms of what is considered to be eligible or suitable asset from an investment perspective, and it's one that we're keeping a watching brief on. We also understand that the Central Bank of Ireland is at the moment revisiting its position on CLO exposure in ETF, so definitely one to keep a close eye on. And finally, and you've mentioned it already, Jamie, great news in terms of the naming requirements for ETFs. The CBI issued some clarification by way of a speech last week. We're able to now use ETF at the sub-fund level or at the share class level as appropriate. And I suppose kind of what this essentially creates is an additional distribution network for creating hybrid structures where ETF and mutual funds can sit side by side, obviously subject to tax considerations. But again, it's putting us on an equal footing as against, I suppose, kind of what's in play over in Luxembourg. So really welcome clarification, and I think this is the direction of travel. There's great opportunity in the ETF market. The retail investment strategy paper is opening up a whole focus from a financial literacy and retail participation in the public market. So lots to watch for any managers that are currently in the ETF space or looking to enter the ETF space.
Fantastic. And Andrew, I'd love to come to you on basically a long list of regulatory updates. A great sort of comprehensive view from Deirdre. So just focusing in on a few there, we've got the recent updates on IRFR, share class naming rules, and obviously ESG sort of naming as well. Maybe if we could dive into those, could you give us your view on how these are going to affect the ETF ecosystem?
Yeah, no, great question, Jamie. So I think I'll focus on the hybrid model because that's really, the conversations that we've been having this year. I'd say close to 100% have been around the active ETFs. Yeah. And then second would be on the hybrid model. So launching an ETF as a share class onto an existing mutual fund. And I will say up until last week, most of the conversations have been around Lux domiciled products, just because back to that naming convention. But what's interesting now, there's essentially a level playing field, but what's really interesting is that it's actually in terms of new asset managers looking at the European space to launch ETFs, it's really bringing firms that maybe 3 years ago would not have had this discussion. It's bringing them to the table, and now they're having conversations. Okay, let's start talking about this. And maybe it's not something that we're going to do in the next 12 months, but we really can't ignore this anymore. So we're having a lot more conversations this year in terms of firms that are saying, okay, we want to learn about ETFs. And in particular, if they're looking to just essentially dip their toe into the market, the hybrid model is what they're looking at, just because they obviously have the historical performance and assets within a mutual fund, and then they can have the ease of launching an ETF onto a share class there. I think that that's definitely really a trend that we'll see going forward. I don't necessarily know if it's going to be a game changer, but what it does is it brings additional players to the market, and it's adding a whole nother. Now I think we have 5 different options for how do you enter the market, whether you build a standalone platform, if you acquire another firm, which we've seen a couple of firms do that in the last couple of years. If you partner with a white label solution, which obviously we've seen some news that there's some new providers in the market in that space. If you go the hybrid model route, or if you do conversions, which is very popular in the US, we've seen a lot of conversions from mutual funds to ETFs in the US. It's not so popular here, but I will say on the flip side, you've got in the US 30 firms that have filed to launch an ETF onto a share class in the US, but here it's already happening and we're having more conversations on that side.
Really interesting stuff. And obviously here at ETF Stream, it's a development we're watching very closely and with a lot of excitement. Monica, coming to you with a similar sort of question. Obviously, there's no shortage of things to touch on there. Obviously, Andrew's given us a lot of colour on sort of listed share classes. We have from Deirdre about sort of ESG naming rules, among other subjects, including OFR updates as well. It'd be great to hear your view on how these are sort of shaping or impacting the ETF ecosystem.
Yeah, so maybe the best thing to do, because there's been a lot of detail, is just look at sort of the bigger picture. So if you think through the fact that there is going to be, I believe, an inflow of new managers that are going to come in to launch ETFs or ETCs, but let's focus on ETFs. I think Andrew's point about using third-party platforms is really valid, particularly because there's now greater choice and the brand names that are entering this market resonate. And so when we're looking and speaking to clients about, well, look, we want to go into ETFs, we weren't very sure, is it too costly to set up our own platform? Even if we have an existing UCITS platform, maybe we don't want to do that, maybe we want an ETF suite. The idea of using a third-party platform is something that resonates with even some very big brands. So I think that's one thing that we're certainly seeing as a trend and something that's not going to go away. In terms of the OFR regime, given I am a UK lawyer, I have a whole bunch of things in relation to it. The one things I would particularly focus on, which I think people need to think about very particularly, and that's why I always focus on distribution, is irrespective of what the EU directives say, distribution is always going to be an issue. When you look at a product registration, that is very, very different from having a proper sales and marketing and distribution strategy. And so obviously the UK is no longer, hasn't been for quite some time, a member of the EU. And so where you have your sales hubs, particularly if you're an incoming US manager, really matters. Where do you really see that depth of sales happening? Is it the UK? Is it ex-UK but in the EU? What does that mean? And what kind of cross-border activities can you do? Particularly if you don't want to have such a large scale in terms of a first foray into the market. So I think that's one thing that we're spending a lot of time practically working through. What does it mean? Yes, it's very important to go through Connect and fill in. And if you're in a temporary permissions regime, then, you know, go by your alphabet and you'll know your landing slot very easily over the next year. But I think those are the types of things that particularly I would advise new entrants into the market to think through. The other piece that I certainly think is interesting is by coming into the UK, you are going to be subject to local laws and regulations, just as you would be if you were marketing within the EU. So what does that mean? You are going to have to look at the FCA handbook. You're going to have to look at the relevant COBS rules, and in particular also maybe think about consumer duty. And in terms of that value assessment, I know that you wrote an article about that on ETF Stream just a little while ago. But one thing I would stress there is that I'm not saying don't this takeaway be value assessment applies. That is not what I'm saying. But what I am saying is that in entrance into the UK market absolutely need to do a deep dive analysis and get proper advice as to what they can and can't do in terms of compliance. I think in terms of sustainability, I agree with Andrea. The mood music has very much changed. Yes, obviously ESG is always going to be important and dear to many people's hearts, but the reality of the economy means that whether it's transition or actually just non-ESG is something that managers are grappling with. We've seen that in recent weeks with some of the pare back of just more general ESG products. So I would absolutely say that's one thing to look through. The other piece that I think sometimes gets lost a little bit is the operational efficiency of setting up these platforms, particularly when you have a look at cross-border type issues. What are you thinking about in terms of your AP strategy? What are you thinking in terms of your market maker? in terms of size and scale of your team. So those are the other types of big picture items that we're certainly spending a lot of time with our clients alongside helping them with OFR registrations.
Great stuff. Andrea, it'd be great to just get some thoughts from you, just a big picture view to finish us off. I'm conscious of time, unfortunately, but a view from you potentially on what are the sort of key regulatory issues you're speaking to clients about looking forward over the next year, in terms of how they're going to sort of impact sort of their ETFs operationally.
Yeah, I was going to actually, if you don't mind, Jamie, comment on tie in 2 points that Deirdre and Monica made in terms of financial literacy and the distribution piece for success for ETF asset managers. So I think there is definitely a lot of opportunity in terms of, moving the regulatory piece aside. I know that's not the topic here, but you look at the growth opportunities here in the ETF space, and it really does tie into, one, if you are a new asset manager, you have to look at your distribution strategy incredibly early. It's not something to consider at launch day. You need to think about it, really at the beginning when you're having conversations with law firms about, okay, what are the nuances of the various markets and what are all the regulatory aspects that we need to be aware of? And then in terms of the other growth opportunity that everyone is talking about is the retail space, and that ties into financial literacy. And everyone talks about the U.S. having a much higher retail adoption than in Europe. There's a number of factors for that. You could loosely say that some of it is financial literacy, but I tend to not agree with that totally, because I think there is definitely still room for education with retail investors in the US. But it definitely is something here in Europe where you have fragmented markets, you have different cultural investment practices for each of those countries. And to be able to reach and educate those retail investors, it's typically done through a number of ways. And one of them is through these neo-broker platforms, which are definitely growing in popularity. They're very popular in Germany, especially with the German ETF savings plans, and they're actually pushing out ETF education because they're partnering with those ETF issuers. I think the other thing, and I'm not the first person to say this, I've heard this from other large asset managers, is that it's really important to start the financial literacy and education at a very early age. So not starting when they're in their mid-20s, but starting in the school system. And I think that's really how, it's not just selfishly for the ETF industry. Obviously, yes, that will benefit us at some point, but I think it's really incredibly important for that financial literacy that Deirdre was talking about, is that it has to be penetrated within the school system, because that's where you can basically reach everyone, because you can't reach, all the retail investors when they're past, university age. So I think that's something that hopefully at some point we'll start to see governments do. I found out recently that it's actually a requirement in some of the school systems within the U.S. I don't think it's, it would obviously be state by state, but maybe that's something that can happen here in Europe.
Great stuff. I'm afraid that's actually all we've got time for today. I think there's probably room for an hour plus discussion on each one of these regulatory issues that I'd love to get into a bit more with each of you. But for today's purposes, I think we've had a really great overview. So I'd like to thank all of our speakers for joining us today, and also everyone at home for sort of listening in. Hope to hear from you all soon. Take care.